Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always, Ritu Singh and Shruti Mishra. These are the top headlines from the startup world. Byju's held a shareholder meet on Saturday and told investors that it will file FY22 financials by this September, while the results for FY23 will be submitted by December, say sources. Byju's added that the resignation of the 3 independent board members is yet to be accepted.
Initial public offering of India's largest drone maker, IdeaForge, fully subscribed by afternoon on the first day of bidding. The retail portion gets subscribed 9 times. The company plans to raise 570 crore rupees. Bids can be placed till the 29th of June.
The government distances itself from full-page public interest ads featuring social media content creators along with the IT Ministry's logo. Minister of State Rajiv Chandrasekhar says the ads do not mean the government endorses the content creators featured in them. Adds that private platforms have been advised to be more careful when using government logos in awareness campaigns.
Icons, a platform for digital IP monetization, partners with Indian cinema legend Amitabh Bachchan as they foray into a generative AI. The Icons team is working with Bachchan to capture his iconic attributes to deliver an experience to fans globally.
Amazon will take its investments in India to $26 billion by 2030, adding $6.5 billion in new planned investments. Announcement follows Amazon Web Services saying last month it will invest $12.9 billion in the country by the end of 2030.
Tech giants could face billions of dollars in fines for failing to tackle disinformation under proposed Australian laws, which a watchdog said would bring mandatory standards to the little regulated sector. Under the proposed legislation, Facebook, Google, Twitter, TikTok and podcasting services would face penalties worth up to 5% of their annual global turnover.
Well, those are the headlines we've been tracking for you this evening. The top story tonight, Byju Ravindran and the new CFO at Byju's addressed shareholders on Saturday. Now, sources tell us that Ajay Goyal, the group CFO, said that his primary focus since joining has been to close the audited financials. He's committed to closing the audit for FY22 by the end of September and the FY23 audit by the end of December. He also provided the reason for appointing BDO as the auditor for the next 5 years. Founder Byju Ravindran too expressed confidence in strengthening all processes with the help of the General Counsel and the newly appointed CFO. Sources also tell us that board members Naspers and Sequoia also confirmed that the resignation of Auditor Deloitte and board members were unrelated. Outgoing independent directors also said Auditor Deloitte had been causing delays and complications in the results. Now, addressing shareholders, Byju Ravindran said, and I quote, "Byju's is not my work, it is my life." He also highlighted his personal investments in Byju's and mentioned that all the secondary sales done have been invested back in the company at the $22 billion valuation. Now, despite the challenges, he said most business verticals are performing well and acknowledged the company's past mistakes and assured shareholders that his learnings far outweigh any missteps. Meanwhile, Byju's has also been making PF contributions with a lag of almost 3 to 4 months, according to data sourced from EPFO by Money Control. In fact, for some employees, the data showed that Byju's made PF contributions for December only in June. When we reached out to Byju's, the company said, and I quote, "This is to confirm that there are no pending PF payments towards employees. There are no dues," end of quote. However, according to the EPFO data, only about 10,000 to 13,000 employees have received PF payments for January, February and March. The majority of employees are yet to receive PF payments for April and June. Clearly, lots of learnings for Byju's, and with that, it's over to you, Ritu.
Well, Shruti, we'll continue to track those developments very closely. Thanks very much for bringing us that update. Now on to our special segment, Voices from the Valley. Today, we're going to put the spotlight on Lightspeed Ventures and how they're leveraging AI to shape the world of work. Speaking to CNBC-TV18 Shireen Ban, Dave Curry, partner at Lightspeed India, said that while there is a downturn in financing for startups, early stage funding has not seen a big impact. Now, he added that AI is one of the biggest green shoots for the startup landscape. Meanwhile, Raviraj Jain, partner at Lightspeed Ventures as well, he said the tech is at an inflection point due to AI and that the quality of founders in early stage has improved. Blume, this is what they had to say. Hear him.
Before we talk about AI, because that's what everybody's talking about, I want to get a sort of overview from you on what the ecosystem currently looks like. You've just come off your annual meeting. What's the sense? Is the worst past us? Is more pain ahead? How confident do you feel?
Yeah, no, thanks, Shireen. Thanks for having us all here. The business of building startups and helping them reach impact has been going on for the last 50 years. It goes in cycles. There are financing cycles, there are business cycles that go on, and we're in one of those cycles where the financing cycles has been on a downturn in the last 1 year or so, perhaps because of global interest rates and other reasons. But the business of investing goes on whether the cycle is up or down. And in the last year, we've seen a bunch of innovative technologies come along or continue to grow from before, and we continue to invest there. Both Tome and Yellow.ai are examples of companies that are innovating, and we continue to see more. So whether it's seed or Series A investing, whether it's growth stage investing, whether it's in our 6 geographies across the world, the US, Israel, Europe, Southeast Asia, India, and China, all of them we continue to invest, and we continue to see lots of exciting things. So yes, there was a downturn in the financing cycle in the last year, but yes, our investing pace still continues. So to answer your question directly, lots of green shoots out there, AI being one of them, but there's areas in biotech, there's areas in climate tech, there's areas in infrastructure software, in application software, and so on, that are all seeing interesting churn and ferment, and that's where we play.
Well, you know, as they've said, within the churn and the ferment is also the interesting opportunities that investors like you are looking at. Raviraj, you know, he talked about the 6 geographies, and in specific, what are you seeing with respect to the US market? Because what we are seeing, at least in terms of headlines at this point in time, don't suggest or don't give you a sense of great confidence or optimism. What's the US market looking like? And more specifically, we have seen a significant slowdown as far as funding is concerned. I mean, Q1 is an example of that, down almost 50%. Do you anticipate a pickup now?
Yeah, so I think I want to just restate what they've said. Innovation doesn't wait for market cycles, right? If anything, candidly, in the last 6 months, I've seen even higher quality of talent raising early stage funding. And that is largely driven by the fact that a lot of really talented people were working at large organizations before, and they were working on really cushy jobs. They were incredibly smart, but they were not thinking about starting up as much. As the market has turned, as there have been layoffs, as there have been people actually reconsidering with stock prices going down, it's like, is this what I want to do? And that is actually driving extremely smart people to start companies. As a result, the quality of founders and the quantity of high quality founders we are seeing at the earliest stage has increased, right? So that's one thing that's happening. The other thing that's happening is the way...
But is this specific to this particular down cycle?
So I've not been around for that long, but I would say, you know, I've been at Lightspeed for 7 years, and thankfully we were on a very strong, you know, positive cycle.
He makes us feel old, doesn't he?
But I think it's certainly true in this cycle, right? More than I've seen in the last 7 years. And so that's one thing. The second thing that's happening is technology is at an inflection point right now. With all the things you're seeing in AI, like we are talking about it all the time because the pace of change has been the highest. But there have been many other areas we are seeing massive amount of innovation, right? And that's driving things. And third, I would say, is like it is true that funding is slowing down, but it's slowing down at later stages because growth stage investment is actually quite tied to how public markets react. Because you're investing in something, you want to see how public markets are valuing those companies. Right. However, where I spend most of my time is the earliest stages, right? That's where it's not really getting as impacted. I would say, if anything, it's actually been accelerating
that has
thanks
been the
to
silver
all
lining.
these factors.
Yeah, no, you're right. That has been the silver lining through this down cycle as well.
All right, moving on. Blume Ventures has announced the first close of their new opportunity fund, Fund 1. This is Blume's third growth fund, and they have already raised 200 crores of the 400 crore target with visibility for the remaining corpus. Now, this new fund comes soon after the close of a massive $290 million fund for last year in a market perceived as adverse to fundraising. To elaborate on plans with the new fund, joining me now is Ashish Fafaria, partner at Blume Ventures. Also joining us is my colleague Ritu. Ashish, welcome back to Startup Street. Now, I believe 3/4 of the corpus would be used to buy assets held by your current funds, providing investors with an exit strategy. If you could elaborate on the fund allocation plans, Ashish.
Sure. Thank you. So we're looking at raising 400 crore plus. And we, of course, have green shoe option as well to be able to raise more in case we have the requisite demand. In the past, we've had the need to exercise it. So let's see how it goes. Of the target 400, we are having visibility and we are just past 300. First close was 200. And we have been in the market since late last year. And the allocation plan of this fund is to make sure that half the corpus is utilized to go deeper into our winners, where we want to invest more primary capital. And the other half would be utilized to buy out stakes where we have very high quality assets and where we believe that there would be an IPO possibility over the next 3 to 4 years, where there are new investors coming in. So rather than exiting these businesses to those incoming investors, we are meaning to use this corpus to buy out from a legacy fund so that it's a win-win-win across all the 3 stakeholders.
All right, Ashish, hi, this is Ritu, and thanks for explaining that strategy, of course. But of this 500 crore, and now of course you've raised half. Was it challenging raising capital in the current environment? And what is the visibility? By when are you looking to close this 400 crore amount? And also, what kind of investors you're in talks with, and how soon you'll be deploying the capital?
So I'll break this up into the 3 parts exactly that you said, Ritu. It is definitely a challenging environment, and we did see a fair bit of skepticism that has been there in the market, particularly coming in from the euphoria and the momentum of 2021. The environment definitely is not conducive for a lot of exits, etc. So when we went out to the market, we were coming on the back of our successful track record. We have already had a meaningful track record where we have had exits in the past, and we have had oversubscription consistently across all of our funds. So to that extent, yes, the process was relatively slower to what it was during the last time we had raised a similar fund back in 2020. But at the same time, when it comes to the appetite, we have seen consistently that if you are able to go out in the market and give clarity on how you are going to utilize funds, your past track record resonates with what you are looking to deploy into, people have rallied up. Okay. So the investor base includes some of the largest of the family offices in India. And what we have now, additional demand coming from, is from a couple of corporate VCs and a fund of funds. So that's where we are at in terms of the 300 of the 400 that's spoken for. And we have already made 3 investments utilizing the corpus of the first close. And we will be looking at closing 2 more over the next 45 days. Okay. In terms of the timeline, Ritu, we are looking at wrapping this effort up around the August timeframe, given that we are just at the last leg. If there is oversubscription, fair, we will look at it in the same time frame. Okay. But broadly, the intent is to wrap it up sooner than later.
All right, Ashish. So you've made 3 investments and you're closing up 2 more. Let's now quickly talk about secondary funds and the exit opportunities in the current environment. You touched on it a little bit. It's a common practice across the globe for fund managers to raise secondary or continuity funds to provide exits to LPs. If you could elaborate on this structure and how Blume is ensuring LPs see timely liquidity and then channelize that money back into the Indian ecosystem.
Sure. So broadly, Shruti, it is a common practice that when you have a 10-year fund, it does eventually either the companies have to go and list, and Indian markets have seen the first batch of companies list only in 2021. And that was not the one of the best phases post listing, but that's a separate topic. And or the other alternative for fund managers is to go out there and sell it to secondary fund managers. India doesn't have a large access to some of these opportunities, and what ends up happening is that a secondary fund manager will buy out these assets from a VC like us. And at times, these will be carried out within the 8th, 9th, or the 10th year of the fund, sometimes just after it. So what we're trying to do here is, rather than go and work with an external third-party secondaries exit provider, we are doing that ourselves, because all of these companies where we are carrying out those exits have a benchmark price that has been arrived at by other investors who are investing already. Given that there is a benchmark price already available, and that too in an environment like this, so one can imagine that we are in the midst of valuation corrections, and we are having an investor who has already come into these companies which are scaled up and doing well. There is a benchmark price that has been set. We're actually transferring at the same benchmark price which an external investor has set. So that's typically the way the process works. It is a newer structure and new opportunity so far as India is concerned. We did that once in 2020, and that fund is a similar $50 million fund called Fund 1X. And that has done incredibly well as well. 4 of those companies raised a follow-on round eventually, and 3 of those 4 have raised in this environment where there has been a lot of stress around, but at valuations which are even better than that. So the market does have appreciation.
Ashish, we're running out of time, so very quickly before we wrap up, all of this money you're raising, you're putting into your own, portfolio companies. Is there a broader theme you're working with, and how many of these companies you've identified will qualify for an IPO in the near term?
So it's a very close knit fund. 9 companies in the portfolio, all pre-disclosed. We do have the ability to shuffle about 25% of this, but the 75% of the corpus will go into these identified opportunities. My reasonable estimate is that at least half of these 9 businesses, at the very least, would go out there and list over the next 4 to 5 year timeline, possibly more. But I definitely can visualize the likes of Purple, Exotel, and Turtlemint, and a few others to go out there and list in the public domain over the next few years.
All right, we've completely run out of time. Many thanks, Ashish, for joining us on Startup Street, and wish you the very best with this new fund.
Thank you. All the best.
On that note, it is time for us to head into a short break. But coming up, iFinance returns to profitability. Where did they see the most demand, and where will the next leg of growth come from? We find out on the other side. Stay tuned. Welcome back. You're still with us on Startup Street. Fintech lending startup iFinance made a turnaround in the financial year that ended March 2023, rebounding from a loss in the previous year. This thanks to strong demand from loans from small and medium enterprises. The Gurugram-based company is backed by the likes of Elevation Capital, Capital G, Alpha Wave, Lightrock, A91 Partners and Maj Invest. Joining me now to discuss the growth blueprint is Sanjay Sharma, the MD and CEO of iFinance. Sanjay, thank you so much for joining us on the show today. You're back to profitability. Talk to us about where your revenues are at. Are you on track to retain profitability? Where did you see the most demand and what led to the growth that you're currently seeing?
Thank you for having me on the channel. And yes, you're so very right that last year has been a bounce back year. I think the micro enterprises that we service saw a very difficult time during the COVID period. And that was the reason that we also had to slow down. But last year, we delivered a 56% growth and delivered a profit of 57 crores, which roughly translates to 3% return on asset post-tax. So those are wonderful numbers. And the good news is that this year has turned out to carry that momentum. We are disbursing close to 30,000 fresh loans every month. And that clearly tells you that there is a lot of demand from the micro enterprises, and obviously these are good times.
Right. So there is clear demand and it's good times for your company. What's the target for your loan book that you have for this year? What about NPAs? Your AUMs have also grown 56%. So where will the next leg of growth come from?
We see that there is a tremendous demand from the trading clusters. So traders are seeing growth. Manufacturing units are seeing growth. So even in the manufacturing sector, we are growing, and so is the service sector. So if I was to point at any specific industry, that would be difficult. But the growth is all around, and it's quite broad-based.
Right.
The growth will come from all these micro loans that we give to these micro enterprises. And the expectation is that we will again grow at about 55 to 60% annualized this year. So I think the momentum is only beginning to build in. The profitability also looks quite good in the initial months.
Right.
So I think this is going to be a wonderful year ahead.
So positive expectations there. Which of your products are you seeing the most traction for? Any new products you plan on launching?
We provide a variety of loans to micro businesses.
Right.
We have term loans. We also have a supply chain based lending. We're also trying out digital lending loans. So far, I think it's the term loans or working capital loans which are working the best. I think most of the businesses are looking for 1.5 to 2 year sort of loan because they want to ramp up their business. They want to buy new working capital and get back to the volume that they used to see during COVID times or prior to COVID times.
All right. And what are the ticket sizes of these loans? Because they are micro loans. So what's the ticket size? What's the customer base like for you? And how do you plan to grow your customer base as well?
We have a active customer base of more than 350,000 micro enterprises. And the typical ticket size is between 1 lakh to 2 lakh. This translates to almost 50% of their working capital requirement in any particular month.
Right. Okay. And you currently, obviously, you have a phygital model. Where are you seeing more traction? Will you grow your physical branches further? What's the target on that front? And where will the focus be, online or offline?
I think we will continue to stay on the phygital model. While we have the ability to do digital, the customer will take probably a few more years to really get accustomed to digitally logging in and requesting a loan. So the answer to the question is that we will see a lot of sourcing through our branches. And we're seeing a lot of very good sourcing from the new branches that we've opened. Typically, East sector or Eastern region is a newer region.
Right.
And there we're seeing a lot of growth. We're seeing a lot of growth also in the North and in South and West. So as I said, it's very broad-based. It's not that one particular state is doing well or one region is doing well. We are in 22 states across India. And I must say that all states seem to be doing well.
All right, all states doing well for you. Now, the Reserve Bank of India has come out with a new FLDG framework, and many fintechs have raised concerns over the default cover for up to 5% of the loan portfolio under these guidelines. What's your view about it? What do you make of this framework and its impact?
I think from one perspective, FLDG guidelines are good because they will deepen the market and increase the lending to the financial world. We, as a company, have a gross NPA of about 2.5%. So a 5% FLDG that RBI allows is significantly above our loss rates. So I think for us, it really doesn't matter. We have been able to manage our loss rates within a very tight band.
Okay.
And I think that is the way every finance company obviously looks at their business. It's not just the FLDG percentage that is a guiding factor.
Right. All right, Sanjay, we're completely out of time, but thank you so much for joining us on the show, and we wish you all the best going forward.
Thank you, and all the best to you.
Well, with that, it's a wrap on this edition of Startup Street. More news continues on the other side. Stay tuned.